age 7, your relationship with time was already broken. And if you've ever wondered why saving money feels like punishment, why investing seems impossibly slow, or why you keep choosing immediate comfort over future wealth, the answer lies in that broken relationship. A relationship formed before you could even understand what time really meant. In the next 50 minutes, you'll understand exactly why your brain fights against long-term thinking. You'll discover the hidden psychology behind compound wealth, and more importantly, you'll learn how to finally rewire your mind for patient, powerful financial growth. But first, I need to tell you about a marshmallow, a 7-year-old, and the moment psychologists realized they could predict your financial future. Whether you're fully focused right now, or simply letting this play in the background while you work, rest, or drift to sleep, your subconscious mind is listening. The gentle frequencies woven into this audio are designed to quietly reprogram your relationship with money and abundance. So there's no need to concentrate. Just relax. Let the words and frequencies do their work. Your mind will absorb what it needs. Stanford University, 1972. A researcher named Walter Mischel places a 4-year-old child in a room with a single marshmallow on the table. The instruction is simple. You can eat this marshmallow now, or wait 15 minutes and get 2 marshmallows. What happened next would reshape our understanding of human nature. Some children grabbed the marshmallow immediately. Others stared at it, covered their eyes, turned around, even licked it without eating it. A few managed to wait the full 15 minutes. But here's what's truly fascinating. When Mischel followed up with these children decades later, those who had waited for the second marshmallow had higher SAT scores, lower rates of obesity, better social relationships, and significantly higher net worth. One simple test at age 4 predicted financial success 40 years later. This wasn't about intelligence. It wasn't about family wealth or education. It was about something far more fundamental, the ability to connect with a future version of yourself. And this is where most people's relationship with money begins to fracture. Because your brain, magnificent as it is, has a profound flaw when it comes to time. It treats your future self like a stranger. Neuroscientist Hal Hershfield discovered something remarkable when he put people in brain scanners and asked them to think about themselves in 10 years. The same neural regions that activate when thinking about strangers lit up when people thought about their future selves. Your own brain literally cannot recognize the person you'll become. This explains why saving feels like giving money to someone else. Why investing seems like throwing money into a void. Why every financial advisor's advice about paying yourself first feels hollow and impossible. You're not paying yourself. You're paying a stranger you'll never meet, whose problems aren't your problems, whose dreams feel foreign and distant. But some people break free from this pattern. They develop what researchers call future self-continuity, the ability to feel connected to who they'll become. And when they do, everything changes. Their spending habits shift. Their investment timeline extends. Their tolerance for delayed gratification increases dramatically. They begin making decisions from a place of abundance rather than scarcity, patience rather than urgency. They discover the silent power of long-term thinking. The tyranny of the present moment. We live in the most present-focused society in human history. Every notification, every alert, every ping is designed to capture your attention right now. Your environment is engineered to make long-term thinking feel not just difficult, but almost impossible. Consider this. The average person checks their phone 96 times per day. That's once every 10 minutes during waking hours. Each check is a small surrender to the present moment, a tiny abandonment of future thinking. But the real damage isn't in the checking. It's in the conditioning. Your brain learns to expect immediate responses, instant gratification, constant stimulation. The neural pathways for patience begin to atrophy. Psychologist Adam Gazzaley calls this interference. The constant stream of immediate inputs interferes with your brain's ability to maintain focus on distant goals. Your prefrontal cortex, the region responsible for long-term planning, becomes overwhelmed by the demands of the present. This creates what behavioral economists call present bias, the tendency to overvalue immediate rewards and undervalue future benefits. It's not a character flaw. It's a predictable response to an environment that rewards short-term thinking. Think about how this shows up in your financial life. You know intellectually that investing early creates massive long-term wealth. You understand compound interest. You've seen the charts showing how someone who invests from age 25 to 35 ends up wealthier than someone who invests from 35 to 65. But knowing isn't enough, because every day, your present-focused brain presents you with immediate needs, wants, and desires. The new phone, the vacation, the restaurant meal, the subscription service. Each purchase feels reasonable in isolation, but collectively they represent a choice: present comfort or future wealth. And here's what most financial advice gets wrong. It treats this as a willpower problem. Save more, spend less, resist temptation. But willpower is a finite resource. It depletes throughout the day. It weakens under stress. The real solution isn't more willpower. It's changing how you perceive time itself. Anthropologist Edward Hall identified two fundamentally different relationships with time. He called them monochronic and polychronic time cultures. Monochronic cultures view time as linear, measurable, and finite. Polychronic cultures see time as cyclical, flexible, and abundant. Most wealthy individuals, whether they realize it or not, operate from a polychronic mindset when it comes to money. They don't see investing as losing money for a period of time. They see it as moving money from one form to another, like water flowing from one container to a larger one. This shift in perception changes everything. When you truly understand that money invested isn't gone, it's transformed. The emotional resistance to long-term thinking begins to dissolve. But there's something even deeper at work here. Something that explains why some people naturally develop this perspective, while others remain trapped in present-focused thinking. The architecture of patience isn't a virtue. It's a skill. And like any skill, it can be developed through understanding its underlying architecture. Neuroscientist Samuel McClure discovered that different brain networks activate when we think about immediate versus delayed rewards. Immediate rewards light up the limbic system, the ancient, emotional brain focused on survival and instant gratification. Delayed rewards activate the prefrontal cortex, the newer, rational brain capable of abstract thinking and planning. When these two systems conflict, the limbic system usually wins. It's faster, stronger, and more emotionally compelling. But here's what McClure found that changes everything. People who consistently choose delayed rewards have developed stronger connections between these two brain regions. They've literally rewired their neural architecture to make long-term thinking feel emotionally satisfying. This rewiring doesn't happen through willpower. It happens through what psychologists call implementation intentions, specific if-then plans that bypass the emotional brain's resistance to delay. Instead of relying on motivation in the moment, you create automatic systems that remove the decision-making burden from your present-focused brain. Consider someone who automatically invests 20% of every paycheck. They're not exercising superhuman willpower every 2 weeks. They've created a system that moves money to their future self before their present self can object. But the architecture of patience goes deeper than systems and automation. It requires what researchers call temporal reframing, the ability to collapse the psychological distance between now and later. Psychologist Yakov Trope found that we think about distant events differently than near events. Distant events feel abstract, vague, and disconnected from our current reality. Near events feel concrete, vivid, and emotionally relevant. This explains why retirement planning feels so difficult. Retirement exists in far mode, abstract and disconnected. The vacation you could take next month exists in near mode, concrete and compelling. But skilled long-term thinkers have learned to make distant events feel near. They use what researchers call episodic future thinking, the ability to mentally travel forward in time and experience future events as if they were happening now. When you can vividly imagine your future self enjoying financial freedom, that future becomes emotionally real. The abstract concept of retirement transforms into a specific, tangible experience worth sacrificing for. This is why visualization isn't just New Age wishful thinking. It's a practical tool for overcoming your brain's natural bias toward the present moment. But there's another element to the architecture of patience that most people miss entirely. It's not just about connecting with your future self. It's about understanding the compound nature of time itself. The compound mind, Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the sentiment reveals something profound about how most people misunderstand the nature of exponential growth. We think linearly. We expect progress to be steady, predictable, and proportional to effort. But compound growth is exponential. It starts slowly, appears to stagnate, then suddenly explodes into dramatic results. This creates what researchers call the exponential growth bias, our systematic underestimation of compound effects. We can calculate compound interest mathematically, but we cannot feel it intuitively. Consider the classic example. Would you rather have a penny that doubles every day for 30 days or $1 million up front? Most people instinctively choose the $1 million, but the penny, through compound growth, becomes over $5 million. This isn't just about money. It's about understanding how growth actually works in any domain. Skills compound, relationships compound, knowledge compounds, habits compound. But here's what makes this psychologically challenging. The compound curve is backloaded. Most of the growth happens at the end. For the first 20 days, that penny grows to just $5,242. It's only in the final 10 days that it explodes to over $5 million. This pattern shows up everywhere in wealth building. The first decade of investing often feels disappointing. The returns seem small relative to your contributions. Your account balance grows mostly from what you put in, not from investment gains. But somewhere around year 15 or 20, the curve begins to steepen. Investment returns start exceeding your contributions. Your money begins making more money than you do from working. Warren Buffett, perhaps the greatest compound thinker of our time, earned 99% of his wealth after his 50th birthday. Not because he became a better investor, but because he understood the backloaded nature of compound growth and stayed patient long enough to experience it. This patience requires what psychologists call process focus rather than outcome focus. Outcome-focused thinking creates constant frustration during the slow, early phases of compound growth. Process-focused thinking finds satisfaction in the daily habits that eventually produce exponential results. But there's something even more profound happening when you truly embrace compound thinking. Your relationship with failure changes. Your tolerance for uncertainty increases. Your ability to think in decades rather than quarters transforms not just your financial life, but your entire approach to building anything meaningful. Researchers have found that people who understand compound effects naturally develop what's called a growth mindset, the belief that abilities and intelligence can be developed through dedication and hard work. This mindset shift is crucial because compound wealth building requires you to become a different person. The version of you that lives paycheck to paycheck cannot create the same results as the version of you that thinks in decades. The compound mind understands that you're not just building wealth. You're building the capacity to build wealth. You're developing the mental frameworks, emotional regulation, and decision-making patterns that enable exponential growth. And this brings us to perhaps the most important aspect of long-term thinking, its effect on your identity. The future self-advantage, your identity, shapes your decisions more than your circumstances. If you see yourself as someone who struggles with money, you'll unconsciously make decisions that confirm that identity. If you see yourself as someone building long-term wealth, you'll make different choices entirely. Psychologist Hal Hershfield conducted a fascinating experiment. He created aged photographs of study participants, showing them what they might look like in 40 years. Then he asked them to allocate money between immediate spending and long-term savings. Participants who saw aged photos of themselves allocated twice as much money to long-term savings compared to the control group. Simply seeing their future self made that person feel real, worthy of consideration, deserving of financial support. This reveals something profound about human psychology. We don't just think about the future, we feel about it. And our feelings about our future self determine our present behavior more than any rational calculation. But creating future self-continuity requires more than visualization. It requires what researchers call identity bridging, finding connections between who you are now and who you want to become. Consider someone who identifies as not good with money. This identity creates enormous psychological resistance to wealth-building behaviors. Saving feels inauthentic. Investing feels pretentious. Financial success feels foreign and uncomfortable. But identity can be gradually shifted through what psychologists call behavioral consistency, small actions that align with your desired identity. When you consistently act like someone who builds wealth, your brain begins to update your self-concept to match your behavior. This is why starting small is so psychologically important. A person who saves $50 per month isn't just building wealth. They're building the identity of someone who saves. That identity then makes larger financial decisions feel natural and consistent. The future self-advantage goes beyond personal identity. It extends to what researchers call temporal landmarks, meaningful moments that create psychological distance from past behavior and enable new patterns. New Year's Day is the most obvious temporal landmark. People feel psychologically separated from their past selves and more capable of change. But you can create artificial temporal landmarks anytime. The first day of a new month, your birthday, the anniversary of a significant event. These landmarks create what psychologists call the fresh start effect, a psychological reset that makes change feel possible rather than impossible. But the most powerful temporal landmark is the moment you truly understand the compound nature of time. When you realize that every financial decision is really a choice between different versions of your future self, everything changes. You begin to see your current spending not as deprivation, but as investment in the person you're becoming. You start making decisions from abundance rather than scarcity, patience rather than urgency. And this shift in perspective reveals something that most people never discover: the competitive advantage of long-term thinking. The patient investor's edge in a world obsessed with speed. Patience becomes a superpower. While everyone else chases quick returns, reacts to market volatility, and jumps between strategies, the patient investor quietly accumulates an enormous advantage. This advantage isn't just about returns. It's about access to opportunities that simply don't exist for short-term thinkers. Consider private equity, real estate investment trusts, or direct real estate ownership. These assets often provide superior long-term returns, but they require patience. You can't liquidate them quickly. You can't check their value every day. You have to trust the process and wait for results. Short-term thinkers avoid these opportunities because they feel risky and illiquid. Patient investors embrace them because they understand that illiquidity is often the source of higher returns. But the patient investor's edge goes deeper than asset selection. It's about emotional regulation during market volatility. Behavioral finance researcher Brad Barber analyzed the trading records of 66,000 households over 6 years. He found that the most active traders, those who bought and sold most frequently, earned 6.5% annually. The least active traders earned 18.5% annually. The difference wasn't investment skill. It was temperament. Patient investors didn't panic during market downturns. They didn't chase hot stocks during market peaks. They simply bought quality assets and held them through multiple market cycles. This emotional regulation is perhaps the most valuable skill in wealth building. Markets will always be volatile. Economic cycles will always create uncertainty. Political events will always generate fear and greed. But patient investors have developed what psychologists call emotional granularity, the ability to distinguish between different types of negative emotions and respond appropriately to each. When markets decline, they don't experience generic fear. They recognize the specific emotion, concern about short-term volatility versus genuine worry about long-term prospects. This granularity allows them to respond rationally rather than reactively. They understand that market volatility is the price you pay for market returns. They've internalized what researcher Nick Murray calls the volatility tax, the emotional cost of accessing equity market growth. But perhaps most importantly, patient investors understand something that short-term thinkers miss entirely: the relationship between time and risk. Most people think longer time horizons mean more risk. After all, more things can go wrong over 30 years than over 3 years. But this intuition is exactly backwards. Over short periods, markets are essentially random. A good company's stock can decline for months or years due to temporary factors. But over long periods, stock prices tend to reflect underlying business value. Time doesn't increase risk, it reduces it. Patient investors can ride out temporary volatility because they understand the difference between price and value, between market sentiment and business fundamentals. This understanding creates what researchers call temporal diversification, the ability to spread risk across time rather than just across assets. When you think in decades rather than quarters, individual years become less important. A bad year becomes one data point in a long series, rather than a catastrophic event requiring immediate action. And this brings us to perhaps the most counterintuitive aspect of long-term thinking: its effect on present happiness. The paradox of delayed gratification. Most people assume that delaying gratification means sacrificing present happiness for future benefits. But research reveals something surprising. People who are good at delaying gratification are actually happier in the present moment. Psychologist Sonia Lyubomirsky found that people with long-term financial goals report higher life satisfaction, better relationships, and lower stress levels than those focused primarily on immediate consumption. This seems paradoxical. How can wanting less now make you happier now? The answer lies in what researchers call hedonic adaptation, our tendency to return to a baseline level of happiness despite positive or negative events. When you buy something you want, you experience a temporary spike in happiness. But within weeks or months, you adapt to the new possession and return to your previous happiness level. The joy fades, but the financial impact remains. People who understand this pattern naturally shift their focus from acquisition to anticipation. They derive more pleasure from planning and saving for future goals than from immediate purchases. This isn't about deprivation, it's about optimization. Research shows that anticipating a positive event often provides more happiness than the event itself. When you're saving for something meaningful, you get to experience the pleasure of anticipation for months or years. But there's something even deeper happening here. Delayed gratification creates what psychologists call meaning-making, the sense that your current actions serve a larger purpose. When your spending aligns with your long-term values and goals, every financial decision becomes meaningful rather than arbitrary. You're not just buying or not buying something. You're choosing between different versions of your future life. This sense of meaning and purpose is one of the strongest predictors of life satisfaction. People who feel their actions matter, who see their daily choices as building towards something significant, report much higher happiness levels than those living without clear direction. The paradox resolves when you realize that delayed gratification isn't about sacrifice. It's about clarity. It's about knowing what you really want and organizing your life around achieving it. Most people never experience this clarity because they never paused long enough to think beyond their immediate circumstances. They're so focused on solving today's problems that they never consider what life could look like if they thought in decades rather than days. But when you develop the capacity for long-term thinking, something remarkable happens. Your relationship with money transforms from scarcity to abundance, from anxiety to confidence, from reaction to intention. And this transformation reveals the ultimate truth about long-term thinking. It's not really about money at all. Beyond money, the life advantage long-term thinking is a meta skill that improves every area of life. When you learn to think in decades rather than days, you don't just build wealth. You build relationships, skills, health, and meaning in ways that short-term thinkers simply cannot access. Consider relationships. Every meaningful relationship requires long-term thinking. Trust develops slowly. Intimacy deepens gradually. Love compounds over time. People who think only in the short term struggle with relationships because they expect immediate emotional returns on their investment. When conflicts arise, when the initial excitement fades, when relationships require work rather than just pleasure, short-term thinkers often abandon ship. But long-term thinkers understand that the best relationships, like the best investments, often look disappointing in the early stages. They require patience, consistency, and faith in the compound effects of daily kindness, attention, and care. The same pattern applies to skill development. Malcolm Gladwell popularized the idea that expertise requires 10,000 hours of practice. But what he didn't emphasize is that most people quit long before reaching that threshold. They quit because skill development, like compound interest, is backloaded. The first 1,000 hours often feel frustrating and disappointing. Progress seems slow. Improvement feels minimal. But people who think long-term understand that skill development follows an exponential curve. They're willing to endure the slow early phases because they know that mastery, once achieved, creates opportunities and advantages that last for decades. Health follows the same pattern. The benefits of daily exercise, good nutrition, and adequate sleep compound slowly over time. You don't see dramatic results in the first month or even the first year. But after a decade of consistent healthy habits, the compound effects become undeniable. Energy levels, cognitive function, disease resistance, and physical capability all improve exponentially. Short-term thinkers struggle with health because they expect immediate results from healthy behaviors. When those results don't materialize quickly, they abandon the habits and return to immediate gratification. Long-term thinkers understand that health is the ultimate compound investment. Every day of good choices builds toward a future self that is stronger, more energetic, and more capable of enjoying the wealth they're simultaneously building. But perhaps most importantly, long-term thinking creates what researchers call eudaimonic well-being, happiness that comes from meaning and purpose, rather than just pleasure and comfort. When you organize your life around long-term goals that matter to you, every day becomes meaningful. Your work isn't just a way to pay bills. It's a step toward financial independence. Your savings aren't just numbers in an account. They're building blocks of future freedom. This sense of purpose and direction is what separates people who build lasting wealth from those who simply accumulate money. Wealth without purpose feels empty and anxious. Wealth with purpose feels empowering and peaceful. And this brings us full circle, back to that 4-year-old child sitting in front of a marshmallow. The choice before you, that child had no idea they were making one of the most important decisions of their life. In choosing to wait for a second marshmallow, they weren't just demonstrating willpower. They were revealing their capacity to connect with a future version of themselves. You face the same choice every day, not with marshmallows, but with money, time, attention, and energy. Every decision is really a choice between immediate gratification and long-term advantage. But unlike that 4-year-old, you now understand what's really happening. You know about present bias, compound effects, future self-continuity, and temporal reframing. You understand the psychology behind long-term thinking. This knowledge gives you power. Not the power to force yourself into perfect behavior, but the power to gradually reshape your relationship with time, money, and your future self. You can start small. Begin with implementation intentions, specific if-then plans that automate good financial decisions. If I receive a paycheck, then I automatically invest 10% before I can spend it. Create temporal landmarks that help you feel psychologically separated from past financial patterns. Use the fresh start effect to begin new habits that align with your long-term identity. Practice episodic future thinking. Spend time vividly imagining your future self enjoying the benefits of your current financial discipline. Make that future person feel real, worthy, deserving of your present sacrifice. Develop emotional granularity around money. When you feel resistance to saving or investing, pause and identify the specific emotion. Is it fear of missing out? Anxiety about the future? Guilt about past mistakes? Different emotions require different responses. Most importantly, Remember that long-term thinking is a skill, not a personality trait. Like any skill, it improves with practice. Every time you choose delayed gratification, you strengthen the neural pathways that make future long-term decisions easier. The compound effects work both ways. Short-term thinking compounds into financial stress, limited options, and increasing dependence on others. Long-term thinking compounds into financial freedom, expanded choices, and the ability to be generous with your time and resources. The choice is always yours, but now you understand what you're really choosing between. Different versions of your future self, different qualities of life, different levels of freedom and opportunity. You understand the silent power of long-term thinking. A different kind of wealth. As we reach the end of our exploration, it's worth reflecting on what we've discovered about the nature of long-term thinking and its relationship to wealth. We began with a simple observation. By age 7, your relationship with time was already shaped by forces beyond your control. You inherited patterns of thinking about immediate versus delayed rewards that seemed fixed and immutable. But we've learned that these patterns can be changed. The brain's plasticity allows you to rewire your relationship with time, money, and your future self. You can develop the capacity for patient, compound thinking that enables extraordinary long-term results. We've seen how present bias, exponential growth bias, and future self-disconnection create predictable obstacles to wealth building. But we've also discovered specific tools and frameworks for overcoming these obstacles: implementation intentions, temporal reframing, episodic future thinking, and identity bridging. We've explored how patience becomes a competitive advantage in a world obsessed with speed, how emotional regulation during volatility creates superior investment returns, how long-term thinking enables access to opportunities that short-term thinkers cannot even perceive. But perhaps most importantly, we've discovered that long-term thinking creates a different kind of wealth entirely. Not just financial wealth, but wealth of experience, relationships, health, and meaning. When you learn to think in decades rather than days, you don't just accumulate money. You accumulate wisdom, patience, emotional regulation, and the deep satisfaction that comes from building something meaningful over time. This is the silent power we've been exploring. It's silent because it works slowly, quietly, without fanfare or immediate recognition. It's power because it compounds into advantages that short-term thinking simply cannot match. The marshmallow test revealed that some 4-year-olds already possessed this power. But the real insight isn't that some people are born with it and others aren't. The real insight is that this power can be developed at any age by anyone willing to understand and practice its principles. Your financial future isn't determined by your past patterns. It's determined by your willingness to connect with your future self, to embrace the compound nature of growth, and to find meaning in the patient work of building lasting wealth. The choice that 4-year-old made in front of a marshmallow, you can make today in front of your financial decisions. Not once, but repeatedly, until long-term thinking becomes as natural as breathing. Until patience becomes your superpower. Until the silent power of long-term thinking transforms not just your bank account, but your entire relationship with time, money, and the person you're becoming. As you continue on your journey, remember that the insights you've absorbed today are already beginning their quiet work in your subconscious mind. The gentle frequencies woven throughout this exploration have been designed to support your transformation from short-term thinking to long-term wealth building. Whether you listened actively or allowed these ideas to wash over you in a more relaxed state, your mind has absorbed what it needs. Trust the process. Trust your capacity for growth. Trust in the silent power of thinking beyond the present moment. The compound effects of today's insights will unfold gradually, naturally, in the days and weeks ahead. Your relationship with money, time, and your future self is already beginning to shift in subtle but powerful ways. And that shift, compounded over time, will create wealth in ways you're only beginning to imagine.